All right, time to get started. We're going to be talking about the all-weather strategies performance. And before we get started, just waiting for people to get into the room and welcome everybody. I hope everybody had a great Songkran holiday. Where did you go over Songkran? I'd love to know. Tell me in the comments. For me, I stayed in Bangkok with my mother. We went on a staycation to the Shangri-La Hotel. But I hear that a lot of people were traveling across Thailand, which is a good sign for the overall economy. So let's hope that things are going well. Today, we're going to talk about the performance of the all-weather strategy. And I'm going to go through some of the things that I've been thinking about a lot these days, as well as also answering your questions. So make sure you're putting your questions in the chat so that I can see them. And then I'm going to go through and try to answer every single question that you ask. So feel free to start putting those questions in the chat. So let's get started. I'm going to, let's say hi there. We got the winner for the first comment. Pangakon, nice to see you. Thank you very much. I appreciate your welcome. It's good to be here. I'm excited to kind of explain what's happening with the portfolio. And, what's the purpose of this whole thing is to try to explain performance, what's working, what's not, get your questions and try to answer those questions as best that I can. So let's go. And I see Nana says, good day. Good to see that. Anybody else out there? Where did you go for Songkran? Type it into the chat. Oh, you guys, come on. I'm going to bring a lot of energy tonight, so I want your energy too. Anybody else out there? Send me a message in the chat so I know you're out there. Anybody else? Where did you go for Songkran? I was relaxing with my mom. It was fantastic. It was fantastic. All right. Feel free to let put your questions in the chat, and I'm going to get started now. So I'm going to switch to full screen and show my screen. And what I'm going to go through is just a review all-weather strategy, which is global, long-term, and diversified. And remember, you can ask your questions in the chat, and I'll answer them at the end. So Danu says, what should we do about China market? First question. I love it. That's a great question. What should we do about the China market? I'll come back to that at the end and I'll answer questions. So did you have a relaxing Songkran? I know this picture is from a prior Songkran because there just wasn't as much playing in this past Songkran. Over Songkran, we had the final presentations of the Valuation Masterclass Boot Camp class number 3. It was amazing. We had 30 students from Thailand, India, Cambodia, Nigeria, Singapore, Indonesia, Philippines, Sweden, Vietnam, Cyprus, and Ethiopia. Wow. The youngest student was 19 years old and the oldest was 52. And there's me wearing my hat, which I have my military style hat because it's a boot camp. It's tough, but we had a great time last week. So if you'd like to join the next boot camp, I have a special offer for you at the end of this presentation. So now let's get into it. We're going to talk about the top 3 global consequences of the war in Ukraine. And we're going to talk about performance review of the all-weather strategy. So let's first get into what's happening in Ukraine and what we can expect around the world already is happening and what will continue to happen. This is the chart that matters the most. What I've done here is created a world inflation measure where I'm market cap weighting inflation. So it's not market cap, but GDP capitalization. So if it's a country that has very high inflation, but its GDP is really tiny, it's going to have a tiny representation in here. Now, we know that the US already has inflation at about 7 or 8% right now. So that's a heavy weight in here. So for developed markets, inflation is running at 4.8%. For emerging markets, it's almost double. This is where the trouble is. In fact, you can see in the highest, it's Pakistan, Lithuania, Sri Lanka, Nigeria, and Turkey. We've already seen crisis in Turkey before the Ukraine invasion. And now we've seen Sri Lanka being brought to its knees because of this environment. And the inflation is causing the cost of food, the cost of fertilizer to rise. And Sri Lanka doesn't have a lot of ways of making the revenue. And look at Thailand. You know, Thailand has some major advantages. First of all, we're food independent. Consider Nigeria as an example. Nigeria, like Kenya, these countries are having a hard time being food independent. They're importing fertilizers, seeds, all kinds of different stuff. And as a result, they're very dependent on the global economy. In addition, Sri Lanka, Pakistan, recently we've seen an overthrow of the government there. And there's a lot of intrigue behind the scenes there. But if it wasn't for inflation rising so high in Pakistan, it probably could have gone on. So this is really a major theme we have to think about is what is the impact of inflation? Now, you may say to yourself, well, Andrew, I don't live in Pakistan. I don't live in Sri Lanka. I don't live in Lithuania. I don't live in Nigeria. I don't live in Turkey. Why should I worry about it? Well, it's a little bit like a tsunami. You may not live where that volcano goes off, where that earthquake happens, but you could feel the impact of those waves. Think about Phuket as an example. When we had the tsunami in Phuket, it wasn't because of an event that happened in Phuket. It was an event that happened thousands of miles away. And that's a key thing that we have to be careful about. If the emerging markets around the world and frontier markets are going through tremendous stress, that is going to cause an impact that's going to be a global impact. It could cause the overthrow of governments. It could cause political instability, and it could cause World War III. In fact, some people may say we're already in World War III. I hope not. And I just wish that the U.S. would sit down with Russia and Russia would sit down with the U.S. and they would discuss and negotiate, because ultimately this is a showdown between the U.S. and Russia. Germany, as an example, is just a sideshow. Germany is kind of caught in the middle, but it's really between the U.S. and Russia. And we need, as citizens of the world, to put pressure on these governments and our governments to get them to sit down. So the top 3 global consequences of the war in Ukraine are: number 1, Europe is running out of energy. That is terrifying. The second is European industrial companies get hammered as production input costs rise. We could see the destruction of the German industrial economy. It could be destroyed because if costs rise so high, they can't produce. And that production is going to go to China. It's going to go to Vietnam. It's going to go to Thailand because it can't be done in Germany. Now, some people who have nefarious ideas think that it could be that the U.S. is actually trying to destroy Germany or weaken Germany. That's something to think about. And keep your questions coming. It's good to see you guys. I see Supansa says hello. And Surasi, nice to see you. Yes. Ark, what is the future direction of the yen in Japan? How will it affect Thailand in the short term? Great question. And Nana says, your view on New World Order, how soon and how will it look like? Great questions, and we're going to come to those. Food insecurity and starvation in poor countries is the next third element. So let's go into the first one. Energy is running out in Europe. Europe can't turn on lights without Russia. Here we can see that Russia and Ukraine share of global commodities supply. In particular, I'm focused on the gas and oil. And from this, you can see that gas from Russia accounts for almost 20% of the global supply of gas, and oil a little bit over 10%. These are huge numbers. In the last oil crisis that happened in Iran, when Iran went through trouble, what happened is that Iran's oil went off the market. That was a 1% contraction in supply, but it caused a doubling in price. This is a huge impact, and it's particularly going to impact Germany. Natural gas prices in Europe have exploded. Here we can see this chart is European natural gas, which is the red line, and oil price, which is the blue line, and on the right-hand scale. Now, I've reset both of these to be 100 at the bottom, and you can see that oil price has gone from 100 up to about 220. This is on an index basis. I've rebased it back to 100. So you don't want to think about the oil price, just think about the rebased amount starting at 100. And here we see European natural gas starting at 100 and going up to as high as 1,200 when the war started. Now it's coming down to about 450. The point is that we have a huge spike that's going on, and that spike in oil is reigniting. Natural gas is coming down because people think, well, the US is going to supply natural gas to Germany and to Europe. That's much more difficult than it seems. They just don't have the ports to receive all that. Now, this burden is transmitted to consumers through higher electricity prices. Think about it. Thailand has an advantage because the government is subsidizing imports right now. We know oil prices are going up. We know gas prices are going up, but you're not paying much more at the pump. Why? Because the government is subsidizing that. The government won't subsidize that forever. We could face a time in the next 3 to 6 months where the government lets go of that subsidy, and you could see a significant rise in oil or gas prices. Of course, the government is hoping that it will start to come down, and then they can recoup some of that and not do as much, but it can go against the government. Here's the average monthly electricity wholesale price in Germany, and we can see that it went up from 50 up to above 200. Now it's down at about 170 or so. It's a significant rise that's being dealt with by the companies in Europe, the companies in Germany. This is the input cost that's pushing up the transport costs. It's pushing up their operational costs. It's pushing up consumers' costs. Now, stimulus drives U.S. inflation, but failed energy policy drives EU inflation. There are two different sources, but they each have very high inflation right now. This is an interesting guy. His name's Alf, Macro Alf. And I thought this Twitter was interesting. The nature of this inflationary shock is very different between U.S. and EU. While price increases in energy and food hit both in the U.S., most of the CPI increase is due to goods and services inflation, mainly because there's been a $6 trillion stimulus pumped into the economy. But in EU, it's more about the poor energy policy. And this chart shows the inflation change and the impact. And what we can see is that it's really driven by energy in the Euro area. So Europe is so reliant on energy imports that it can't cover its needs without Russia. Here, I've got the 15 largest economies. They're all highly dependent on oil. What I'm looking at here is the gap. I'm just going to grab my pen here. I'm going to play a teacher role here for a second. And I'm going to say, here's how much Germany is consuming. Here's how much they're producing. And the gap between the two is, as a percent of the total, 65.6%. That's a huge gap. Only Norway is a net exporter of energy. The largest economy, Germany, is highly dependent on Russia. This is a good way to explain how Europe's energy crisis is self-inflicted. We need to stand up to Putin's increasing aggressiveness. Then they continue shutting down domestic nuclear power plants. And now they're completely reliant on Russian natural gas. That is a little humor about the situation. So here, Europe cut back heavily on fossil fuels without any substitution plan. This chart shows the red bar. Europe cut traditional energy sources by 2 gigawatts per hour, from 6 down to 4. And they increased renewables. Great. That's great that they increased renewables, but those renewables only increased by 1. And that is a problem. Renewables are not going to save Germany, and they're not going to save Europe. And keep in mind, they're not going to save Thailand. Almost all renewables out there are being subsidized by governments. Why are they being subsidized by governments? Because they're expensive to create. So if it wasn't for government subsidy for solar panel and all the other types of things out there, it would be very expensive. Renewable production is still far away from satisfying energy consumption in Europe. These countries in Europe must import more than half of its energy. That is a major dependence on energy. Now, this is why when I was saying maybe the goal of the US is to destabilize Europe or to weaken Europe or weaken Germany, because the actions that they're taking is going to have a very strong consequence in Europe. And Europe keeps prolonging this situation. They're not going to stand up to the US and say, we've got to negotiate with Russia and come up with a solution. And they're going to sit there and they're going to let themselves be starved of energy. So the Green Revolution results in return of brown power. I think I've talked about this one before, but this guy on the left said, in hindsight, taking energy advice from a Swedish teenager was a really bad idea. The point is, the movement to renewables is driven by a hysteria, an excitement. We all want it, but it is not going to happen as fast as we want it based upon the pace that it's going. And you're seeing that in Europe. So energy is so scarce and Europe is so desperate that coal is seeing a comeback. Remember, everybody said we got to get off of coal. Coal usage in Europe in early 2022 rose to 15% of total energy consumption. That's up from 10% previously. It's already a major increase. Italy is considering firing up its existing coal plants as it has no nuclear capacity to replace natural gas. In fact, it's France that has nuclear capacity. So let's look at consequence number 2. European industrial companies get hammered as production input costs rise. So Russia is a main exporter of various metals as well as Ukraine. Here we can go back to the same chart and we can see that palladium is 40% of the global supply. Nickel is about 7, aluminum about 5.5, copper about 4, zinc about 3. Those are all significant. You could say that zinc is pretty small. Now, I see you guys are asking questions. That's awesome. Keep your questions coming. I see some of the questions. Let's see right here. First of all, I see Kelly. Kelly just graduated from the Valuation Masterclass Bootcamp. We know that wasn't an easy feat. Plunpun says, at what conditions, inflation level, GDP, rate hikes, oil price, Russia over or U.S. equity will come back? So what will it take to get equity to come back? Good question. And I'm going to come through with that at the end. Danu says, I've invested with AWS, a big fan. Anyway, I'm just wondering why we keep cash around 4%. Should we convert it into something in the future? Excellent question. We'll come back to that. I'm going to mention that Alex is on the line from my team. And Alex, maybe you can give any thoughts to that. And you and I will talk about that on Slack. All right. Chawapon says, as the higher volatility of commodities such as gold, how can you make higher return from this opportunity? Good question. I'm going to answer that. Cindy says many consequences. Yes, exactly. Kompon says, hi, glad to join. We stayed home during Songkran. Yeah, it's a great time to stay home. I know a lot of people love to travel, but for me, I love to be in Bangkok at that time. Heisenberg says 10 years Thai government bond is 2.69, while 10 years U.S. Treasury is 2.88. Is this implied Thailand's economy is stronger than U.S.? I would answer that by saying that difference is so small that I wouldn't say that you're going to get that implication. Also, is it time to invest in Europe? That's a good question. And I got some thoughts on that, which I'm going to share. Kashikon Asset Management has been rolling out several super low-cost index funds. Do you consider replacing our current index funds? It's possible. We always look at opportunities. So please, you can forward some of those funds that you find interesting. Let me know. Communicate directly with me here or through your advisor. Definitely. What's your view on Japan? I'll come back to that. Thanks, Lee. I appreciate it. Also, too late to invest in commodities fund. What do you think? That's a really tough question. Live chat is Burr, but not sure only me. Yeah. We'll come back to all these questions. Keep these questions. Let's just see. Okay. So I'm going to stop sharing that, but keep your questions coming. I see Ben. All right. Now let's go back to where we were, and metal prices are on the rise. Russia supplies almost 20% of global high-quality nickel used in EV batteries, and palladium is used in catalytic converters for cars, and EU gets more than 40% of its supply from Russia. Now, not all of these are up. There's other factors out there, but you can see that there's a general rise, definitely in palladium just recently, right? We can see that a rise has happened. Where is my pointer? We can see a rise starting to happen, but really the big one has been nickel. And we had a rise that was happening in aluminum, a little bit of a down, but I would say these are all at risk of rising. So substitute for Russia's premium nickel is needed. Around 70% of the global nickel supply is used to produce stainless steel, and another 7% is used for batteries in electric vehicles, which requires high purity nickel. And that's the type of nickel that's coming from Russia. Let's talk about the third element, and that's food insecurity and starvation in poor countries. I'm just saying, I'm not a Thai politician, but if I was a Thai politician and I was advising one right now, I would have an emergency gathering of leading people that's going to make sure that we have food security over the next couple of years. If we go into a highly inflationary environment, an environment of scarcity, if we go into an environment of World War III, we need to make sure that we in Thailand are able to feed ourselves, which we are. We have that capacity. In fact, we're a net exporter of food. But I would just say that we have the ability to produce low-cost, good-quality food. So export bans of Ukraine and Russia disrupt global supply chains. Now we get down to soft commodities, and that's corn and wheat. And here we can see, obviously, there's a huge impact. And when you're in the middle of a war, you're not going to go out and farm. So the farming, the season now is farming. And so it's time to plant. It's not happening. Wheat and corn are up significantly. Ukraine has banned the export of wheat, oats, and many other staples to ensure sufficient supply for its population. So even if they were growing it, they're not exporting it. So Russia responded to Western sanctions with an export ban of over 200 products. Even if they're growing food, they're not releasing it into the global market. And we can see that in the price of corn and in the price of wheat. These prices are up significantly. Why does it matter? You may say, I don't eat that much corn. Well, in fact, corn is a primary input for feed grain of livestock and poultry. So it is a significant one, as well as wheat being pasta and bread and all of that. It's a major staple food in much of sub-Saharan Africa. Wheat is an important ingredient for bread, pasta, snack food, and cereals. So food prices have hit all-time high. You can see the worst. This guy, Andreas Steno Larson, says the worst month ever in the UN Food Price Index was March 2022. You can't deny it at this point. We are facing significant escalation in food prices as a result of the war between Russia and Ukraine. And the US in particular is doing nothing to stop it. They're not negotiating. They're not talking. They're not having diplomatic connections with Russia. they're doing nothing. And I'm not, Russia is at fault for what they've done. But the point is, America has the power to stop this right now by sitting down with Russia and negotiating. I've already talked previously about how NATO expansion has been a key policy by the US over the last couple of decades. And Putin has made it clear that that is an existential threat to Russia. And so the point that I would make is that both parties need to sit down and talk. The food crisis is going to hit the poorest countries. We got Egypt and Turkey getting more than 70% of total wheat imports from Russia and Ukraine. They are huge importers. And you can see other countries on here that are massive importers of both wheat and corn. In fact, Thailand also imports a large amount of corn. I believe it's about 3 million metric tons. So Thailand's just a little bit below this cutoff. And that price is going to be rising. So this could lead us to social unrest and food riots. We've seen it in 1977 in Egypt, in 1989 in Argentina, in 2007 in West Bengal, and 2016 in Venezuela. And we could literally be coming back to that. And that is scary. So expenditures on food relative to income is highest in the poor countries. Here we can see sub-Saharan Africa is spending a lot more on food than, let's say, North America in the US, which is spending less than 10% of their income. So food is cheap in the West. So this type of inflation is going to be crushing inflation. I just was talking to a friend of mine in Kenya, and they were saying that they were seeing that prices are rising every single week in the supermarket. Countries like Kenya, countries like Turkey, countries like Egypt, countries like Nigeria, many other countries are going to be hit very hard. So what are the key takeaways? Europe is heading for an economic crisis without Russian gas. High energy and commodity prices strike a heavy blow to European industrials. And the secondary impact of high food prices and scarcity will smash developing countries. And that's the idea, like I said, about the tsunami that hit Phuket. The point is that it didn't happen in Phuket. It happened far away. And what can come from developing countries going through crisis can hit all across the world. Just look at the situation in the Middle East. When America destabilized the Middle East, more than 1 million refugees left the Middle East and brought a migrant crisis really to Europe that they're assimilating right now. So let's review the performance of the all-weather strategy. So first of all, commodities remain strong in the past month, and the strategy is 11% above the 60-40 portfolio since inception. War in Ukraine, recovery demand, and supply chain bottlenecks to drive commodities and gold. Of course, the risks to the all-weather strategy is inflation quickly gets under control, global recession, Fed rate hikes crashing the U.S. market. So to summarize, the asset class weights since March of 2022 are 45% equity, 5% bonds, 25% commodities, and 25% gold. I wish that we had less gold, but I can't get everything right. So we make no change to allocations in this performance review. So right now, we're just reviewing what's going on and taking as many questions as we can. The next revision. So you may ask me, Andrew, when is the next revision? Well, here's the answer. It's going to be at the beginning of June. So look out for the beginning of June when we do the next. So regional equity weights since March 2022 also, we make no changes here also. We've been 25% US, 5% developed Europe, Japan, emerging markets, and Asia Pacific, ex-Japan. So I just want to welcome everybody into this call. I know that we've got about 340 people on it, as well as about 8,500 people in the line group. So if you're in the line group, I welcome you into this. Feel free, if there's a way that you can ask questions, but enjoy the show and hopefully it'll answer some of your questions. Now, this is a table that I created a long time ago, and this gives me a little bit of idea about what's going on. So I'm just looking at this. I'm looking at as of the end of last week. U.S. rebounded in the past month, up about 5%. While Hong Kong stocks recovered, mainland China remained weak, and key European markets rebounded too. We can see a rebound. And that raises a question, should we be investing in Europe now? That's one of the questions that we've got. Remember, if you've got questions, make sure that you put them into the chat. I will try to get through all questions. I got a lot of energy tonight, and I'm going to try to get through everything. Now, if you want to get this table updated on a regular basis and use it like I do, just go to my website, valuationmasterclass.com, and go to resources, and you'll be able to access it. All right. So let's review. The war in Ukraine has continued to bring volatility to financial markets. Besides, market participants have reacted to central banks signaling tightening. Now, since the inception of the Bloomberg U.S. Treasury Total Return Index in 1973, first quarter 2022 was the worst on record. In other words, the bond market was down 5.6% in the first quarter. That's the worst since it started. Let's review a few tweets from April that I saw. First, the Fed drives market movements, and Fed vice chairman says Fed needs to crash the market. What Fed is going to do or not do has continued to rattle markets. Let's see. This is Sven Heinrich, who says, over the years, I've argued the Fed has become the prime driver of stock market direction to manage the economy. That worked during deflation. Now, having lost control of price stability, former Fed Vice Chair Dudley says the Fed needs to drop the market. The title of this article by Bloomberg is, If Stocks Don't Fall, the Fed Needs to Force Them. Tightening financial conditions will be key to getting inflation under control. Now, that's just crazy, right? This would be the Fed crashing the market to try to stop inflation. Now, let's just think about that for a moment. The U.S. and the world is going through inflation. That inflation is caused by two factors. First, a huge amount of money printing by the U.S., the EU, and any other country that could do it. Thailand can't print a lot of money like that, or else our baht will get hit and it will lose value. But the U.S. can. So there's been a huge amount of money printing, which is causing general inflation. Now, that inflation is causing the value of the dollar to fall, meaning the cost of all the products and services are getting more expensive. Now, the inflation that we're seeing in Europe is caused by higher energy prices. That's a supply shock problem that's pushing through the economy. If the Fed starts to raise rates, I suspect it's not going to have a huge impact on inflation, and they run the risk of crashing the economy and crashing the market. And it's my contention that they're not going to do that. Once they start to raise rates once or twice more and the market takes a hit, they're not going to let the market crash. Why? Because we have a November election coming up, but also because people expect the Fed to help. Now, global bonds have seen the worst return in decades. Here's another one by Holger Zasipitz. The biggest bond bubble in 800 years continues to deflate after the start of the Fed's rate hike cycle. Ahead of next week's ECB meeting and as rising inflation shakes up bond markets, the value of global bonds has dropped by another $960 billion this week, bringing total loss to an all-time high, $6 trillion of losses in the bond markets. It is a massive crash that's happening in the bond market. And luckily, we have not been exposed to that. We only have 5% of the portfolio in the bond market. Now, China stayed locked up. Nearly 400 million people across 45 cities in China are under full or partial lockdown, according to Eddie Effelbein. And it's the biggest risk to the global economy no one's talking about, this article says on CNN. Nearly 400,000 million people, that's not right, but it's about 400 million people across 45 cities are under lockdown. Now, you've seen what's happening in Shanghai. It's terrifying what's going on, but that can really, really slow down China. And this is a major risk to being overweight commodities. If China really slows down and they stop the demand of the commodities, we could be in trouble. So we always have to know the risk that we're exposed to. That is a risk. So we've had significant outperformance by AWS. You can see over the past month, AWS was up by 4.3%, which is
driven by, that's about 1.9% above the traditional 60-40 portfolio. This is for 1 month. Commodities were the best performing asset, and we were heavily weighted in them. Also, the U.S. was a pretty good performer. It was the third best performing equity market, and we were overweight there. And bonds were weak, but they were still up. And remember, we're not buying bonds in this portfolio. We're not buying bonds to speculate on bond prices rising. We're buying bonds as protection if the equity market falls. That's a key distinction. I would also say the same for our 5% allocation to bonds, and that is for gold and bonds. They are good protection when the equity market falls. Now here we can see the performance. Basically, the strategy was 11.1% above a 60-40 portfolio as of 15th April 2022. So we started off this year and it was a little bit rocky, but we managed to pull out strong outperformance based upon our FVMR investing style. And also based upon not doing too much. We didn't rebalance a lot at the beginning of this year. And the result of that is that by sitting on a good asset allocation, we just let it work. So AWS has shown a strong performance. We can see the risk-adjusted return was better than the 60-40. And what's the drawdown adjusted return was also better than the 60-40. So also AWS has experienced less volatility. Here we can see the annualized volatility at about 10.4%. Now we've had a target weighting of between 25 and 65% for equity. That's reduced the volatility because we're in other asset classes. Since gold is generally uncorrelated to equity, it has reduced the overall AWS volatility. So gold, sometimes you guys will ask, why do you have 5% in any particular asset class? Why not make it 0? Even 5% can protect downside if it's in gold or bonds. AWS has lost less on 8 out of the 10 worst days. So what does this chart mean? Let's review. When the market was down 5.6 on the 12th of March, 2020, AWS was down about 4.3 less. When the market was down 6.4% on the 16th of March, which was the second biggest fallout in the market since we've been doing AWS, AWS was down less and less and less and less and less than the market and less than the 60-40. Here we were worse performer right here, but not by a huge amount. And here we can also see we perform more poorly compared to the 60-40, but not by a lot. And here we can see the final one was less. So 8 out of 10. A key feature of AWS is that it aims to lose less when equity markets fall. Of the 10 worst days of global equity since the inception of AWS, the strategy has lost less than the 60-40 strategy on 80% of the days. So we're succeeding in that thing that we're trying to do, protect the downside. AWS outperformed a 60-40 portfolio in 65% of the months. In 24 out of 37 months, that means 65% of the months we've beaten a traditional 60-40. Does anybody know what Warren Buffett's success ratio is? If our success ratio is 65%, what is Warren Buffett's success ratio? Do you know that? That's my quiz for you right now. I'm going to sit down a little bit and relax as we continue on, and we're getting very close to the Q&A. We're going to get into that, but I'm going to sit down and bring my desk down here. I'm sure some of you guys have a nice standing desk, and I got one too. So does anybody know what Warren Buffett's success ratio was for his stock portfolio? Put it in the chat if you know. Make your guess. What do you think it was? Warren Buffett's success ratio. I just recently calculated it, so I know it. Can anybody make a guess? 75%. Good guess. Pun. What about others? Other guesses? What is Warren Buffett? The best investor of all time. 72%, 60%, 75%. These are excellent guesses. 80%. So now
you can't compare Warren Buffett's performance to this performance because Warren Buffett was owning stocks and he was owning a very concentrated portfolio of stocks. That's a much harder thing to beat the market. He did an amazing job. And I would say that the person who is closest is, what is that? Siupon, who says 65%. And that's about right. It's about 67% is Warren Buffett's success ratio, meaning 33% of the years that he was investing over 57 years, 33% of them, he underperformed the market. That is an amazing ratio. Again, I want to welcome everybody onto this chat. I'm almost finished with the presentation. I'm going to move into Q&A, and you've got some great questions. And I see that there's about 340 people that are on the chat. I welcome you into the group through YouTube, through Facebook. And also I see that there's 10,000 line starts. So welcome everybody from line. So yeah, Lomo Fat Boy said, I just noticed that you can read Thai. Well done. Thank you. I'm very slow. Wit says 66.67. Yeah, that's probably more correct. Yes, take Wit's calculation there. All right. So expect continued high volatility. In the near term, we expect continued equity volatility due to the war in Ukraine. In our revision in March, we reduced the equity allocation to 45% equity from 65%, and we raised gold to 25% from 5%. Now we expect the Fed to support the market. American companies are doing well and have global pricing power. U.S. economy looks like it could remain strong, but that's driven mainly by government spending. Biden and the Democrats need Powell to prop up markets ahead of November midterms. So this is a chart I just made today that I thought I would share with you. I think it's a fascinating chart. It's the return on equity of all the companies in Germany, France, UK, and US. What we can see is the long-term average return on equity in Germany was 11%, France 11%, UK 14%, and the US 16%. Now our weight is 25% to the US and 5% to Europe. And you can just see that basically Europe doesn't have a lot of cushion. So when they're going down for the return on equity, it's getting very close. Now I'm only updating this till 2020. I only have 50% of the companies have fully reported so far. So I decided not to show 2021, but I suspect in 2021, you're going to see the US rebounding and some of these countries going down even more. This is a substantial point because it tells us that Europe is not in a good place to withstand a crisis. So one of the questions was, when is it time to start investing in Europe? I would say you probably have somewhere between 2 to 8 quarters before you do that. Let's say between 6 months and 24 months. You're getting there. Now the Fed hike in May is already priced in. The market is pricing in 100% certainty of another Fed hike in May of 2020. The implied probability is 9% for a 0.25 and 91 for 0.5. And 2 weeks ago, the implied probability was 69% for a 0.5% hike. This is a chart that shows the probability weighted Fed target rate. And what we can see is the market has raised expectations to even more aggressive Fed. So let's look at what this means. If we just look at this red line and we go to the end of this year, 2022, and that's December, people are expecting that the Fed funds rate is going to be a little bit under, let's just say 2.75 right here. That's where they expect it to be. And right now it's at a little bit under, it's at about 0.75, right? It's at 0.75 right now, and they're expecting that it's going to go to 2.75. That's 200%, 200 basis points increase, or 2 percentage points increase. That's pretty substantial. And the market expectation, you can see that the line has been rising because in March of this year, it was the dotted line. And by April, just 1 month later, it's already risen. So investors and the market expect that the Fed is going to start raising interest rates and continue raising them over this year.
The Fed needs to balance inflation with increased recession expectations, though, is what I think. And we might see more hikes, but I think that the Fed will be cautious due to the war in Ukraine and not risk a market crash. I think inflation is causing a hugely damaging impact on the overall economy. It can slow down an economy, but more importantly, what's going to happen is that the U.S. stock market is going to start to be at risk. And if the market is at risk and starts falling, you have a November midterm election coming up in the U.S. It's very unlikely that the Fed is going to just let the market crash. The Democrats are going to put as much pressure on the Fed as they can. Now, a strong dollar hurts emerging markets. The Fed hikes and tapering are likely to result in a stronger dollar and less global liquidity, which could hurt emerging markets. Also, US dollar is considered a safe haven, meaning it can strengthen further as a result of the war in Ukraine. Now, let's look at China's heavy weight because it matters. I've highlighted the Chinese A-share market, which has been crashing, and China's heavy weight in the emerging markets in Asia Pacific could continue to drag on performance. Now, somebody asked me about the Chinese market. Should I allocate to the Chinese market right now? And I would say, I think that China is probably beginning to be a buying opportunity. I would buy China before I would buy Europe right now. I think Europe's got a little ways to go, but just be careful about Chinese. If you buy a Chinese index, 30% of the weight of the index is in Chinese banks, and Chinese banks are definitely at risk. So I would just be careful. I would be selective if you can. Bonds to remain flat. That's our outlook. In the near term, we think bonds will underperform equity, which is why we have a 5% allocation. Our allocation is tied money market. That means short-term bonds. So Fed rate hike should have less impact. In addition, short-term bonds are typically less negatively impacted due to their short duration. So to go back to the question about Thai versus US, we're not too impacted by that because we're in all-weather strategy. We're owning the Thai short-term bonds, which aren't going to move as much as long-term bonds. But, still there's risk there. So commodities are set to go higher. We have a 25% target allocation to commodities. Recovery demand, inflation, and supply chain disruptions related and unrelated to the war in Ukraine are going to drive the asset class higher. Energy prices to remain high. Europe's Russian energy dependence is going to continue to influence energy markets. Here you can see, I look at the same chart we looked at before, European natural gas and oil price, but this time I rebased both of them to 100 equally. And you can see the massive increase in the cost of natural gas in Europe. It's come down a bit as America seems to be claiming they're going to come to the rescue of Europe. But I would suspect that once we see that Russian gas stops flowing into Europe, there's no way America can quickly and sustainably increase the amount of natural gas in Europe and replace the Russian gas. Now, the Ukraine war disrupts supply. Besides energy, Russia is an exporter of many metals, and Russia and Ukraine are also exporters of soft commodities. Putin's move to avoid settlement in, for example, US dollar or euro is likely to be another disruption to the commodities market. So still see overweight in commodity position makes sense at this point. And food is getting more expensive. Natural gas is used in fertilizer, and higher fertilizer costs lead to higher grain prices. Also, Russia and Ukraine account for 15 to 20% of global supply of corn and wheat. And corn is primarily an input for feed grain of livestock and poultry, driving up meat prices. Wheat is an important ingredient for bread, pasta, snack food, and cereals. Egypt and Turkey, as we looked at before, get more than 70% of total wheat imports from Russia and Ukraine. Now, let's talk about gold, because some people look at gold in a different way than we look at gold. We have a target weighting of 25% in gold as insurance. The war in Ukraine spurs uncertainty, and inflation expectations could rise, making gold attractive, though expected rate hikes and recession concerns are negative. Here you can see that since the invasion, gold had a spike, but then it kind of leveled off. So gold hasn't done a whole lot. The gold market may suggest that the Fed will be forced to continue to prop up the markets. Let's look at this for a second. Why is it that gold is not racing up in all of this situation? One of the reasons why gold is not racing up is because people may think, yeah, the Fed is going to come to the rescue. They're going to bail out the market. So why should I own gold when the Fed is going to rescue the stock market? That is a theory as to why gold is not going up. In fact, this guy, Jurian Timmer, says perhaps gold knows that if bond yields keep rising to the point of undermining growth, meaning bond yields rise, the U.S. economy starts to slow, that the Fed will be forced to dust off the 1940s playbook by continuing resuming asset purchases indefinitely, much like the BOJ has been doing for years and the ECB is hinting at right now. So what is he saying? He's saying investors are not rushing into gold because they know that though the Fed is talking tough about raising interest rates, they're not going to be able to do it. In fact, the market's going to start crashing, and then what's going to happen is the Fed's going to panic and start buying. My prediction is before the end of 2022, the Fed will buy stocks in the stock market. And as a result, this argument is that that's the reason why gold is not going up. Is it a right argument? I don't know. But what I love about Twitter is you definitely get a lot of different ideas. Now, our ideas are done through our FVMR framework, and then we execute them, but I'm always looking for good thoughts and ideas. I want to stop for just a second there and say to ME Experience, great presentation. I appreciate that. We work hard to try to bring you stuff that's not too confusing, that's clear, and gives you the ability to kind of think about the strategy that we're doing, the strategy that we're implementing. One of the things that in my career that I saw was that a lot of fund managers were not great at communicating what's happening in their portfolio. They also weren't great at admitting when they were wrong. We've made some wrong calls and then we've reversed them and we've explained those wrong calls. And in addition, I'm also explaining very clearly to you the risks of this strategy. Well, if inflation started coming down, that's a major risk because we're overweight commodities. If gold was no longer a valuable asset because people thought everything's fine, the war's over, whatever, then we could be at risk in this portfolio. In addition, if the equity market started racing up across the world, we wouldn't be exposed that much to the equity market. We would be hurt. Those are some of the risks that I see in this portfolio that you need to be aware of as you're managing your own money. And you're using this strategy as one of those tools in managing your own money. So inflation, so let's go through those risks now. You need to understand that all weather strategy has risks. We're not going to be knocking it out of the park all the time. So first one is inflation quickly gets under control. The strategy is still positioned to benefit from rising inflation at the beginning of 2022, and we haven't changed that position. We could be wrong. There's a risk that inflation is transitory now and falling faster than we expect, which would hurt our performance because we're so heavily weighted in commodities. A quick resolution of the war in Ukraine would also lead to lower commodities and gold prices, and our portfolio would be hurt. Now, global recession could push down stocks. The new COVID mutations could arise. We've started to see yield curve inversion, which has historically been an accurate predictor of recession. So we could be at a situation where we start to see a potential recession. That's a risk. Since 1970 in the US, the average time from inversion until the recession started was about 12 months. So right now we've been going through inversion. That would mean by almost the end of this year, in the beginning of next year, we could see a recession. That's a risk. And finally, Fed rate hikes are crashing the market. If the Fed would surprise, now think about this. I've showed you that pretty much everybody out there believes the Fed is going to increase interest rates. I don't believe the Fed is going to be able to do that for very long. What's going to happen is that we're going to run into our next crisis, and that crisis will probably be the stock market crashing. And when it crashes, people are going to demand that the Fed step in to stop the market from crashing. They're going to say people's savings and Social Security and all these different things are tied up in it. You've got to save the market. And remember, we have an election in November. The Democrats basically are going to be in a situation where they're going to lose the House if they let the market crash. So everybody believes that the Fed is going to increase interest rates. I think that they're not. Now, if the Fed would surprise and not be cautious about rate hikes, it could impact the U.S. stock market negatively. And what you would see is that our exposure to the U.S. market could come down, right? We would see a loss in that area. The U.S. stock market usually has a global impact, hence it would hurt other equity markets too. If the U.S. comes down, Thailand and other markets are going to come down much more. They tend to be, particularly emerging markets, more volatile. So that's another risk. If you are overexposed to Asia or emerging markets, you could see that if the U.S. market crashed, you would be impacted. So what are the key takeaways? All-weather strategy outperformed a traditional 60-40 portfolio by 1.9% in the past month. And I believe that is after all fees, or pretty much all fees. The Fed's unwillingness to crash markets to support equities. I think Fed will eventually have to support equities. The war in Ukraine, recovery demand, and supply chain bottlenecks to drive commodities and gold. And the risks are inflation's quickly getting under control, global recession, Fed rate hikes crashing the U.S. market. These are the main points. We're going to move into the Ask a John, Andrew, any question that you want. We got a lot of great questions. But before we get into that, for those of you that really love stocks and valuing stocks, I want to introduce you to the boot camp. Our next 6-week valuation masterclass boot camp starts on May 23rd. And this was our latest group of people. We actually had 30 graduates this time. And batch 3 attendees identified 6 things that made their boot camp experience unique. I don't think that Kelly, who was in the boot camp and is on this call, has seen this list. I don't think Lee, who is a valuation masterclass, Lee Rigglesworth is a valuation masterclass graduate, has seen this list. First, they transform to be a more focused and determined person. Second, they learned everything that they needed to become a successful financial analyst. Third, they experienced a challenging yet supportive environment. They gained advanced valuation knowledge presented in a simple way, and they focused on practical aspects of finance and valuation, and they enjoyed a powerful and engaging teaching style. That's my style of teaching. So for those of you on this call, if you want to attend the Valuation Masterclass Bootcamp, or you have a son or daughter that you think should attend the boot camp, this is a coupon code called Phenomena for you that's going to give you an ability to save $750 until May. You can go to the valuationmasterclass.com/bootcamp or just go to the QR code and you can learn more about it. If you have questions about it, you can also book a call with me and I'll do a short call to try to explain what it is, and you can determine whether it's good for you. So if you sign up before April 22nd, I've got a little bonus, and that is my Achieve Your Goals course, which is valued at $147. And that is really my outline of how I achieve the goals in my life. It's time for Q&A. I'm going to stop sharing my screen now, and I'm going to move into full screen mode, and I'm going to start to answer questions. So let's get into that. I'm going to go back up to the top and try to get to the questions that we had all the way at the top. And let's get started. The first one is, what should we do about the China market? I would say you can see that my minimums, now I don't have the China market in this portfolio because the purpose of all weather is not to get so specific. We have only Japan as a separate market, and that's a developed market. And we have it only because we have Asia ex Japan. We don't have Japan. But I don't get into China in this portfolio. But if I was allocating around the world at different countries, I would say a small allocation to China now, to me, is somewhat interesting. So I would say small, though, because there's a lot going on. We could get worse numbers coming out of China. That would be my answer. Nana says, your view on New World Order, how soon and how will it look like? So at this point, what I would say is that the U.S. has extreme power. They have the power to shut anybody out of the global financial system. They have the power to continue a war or stop a war. They have the power to print money without causing huge damage to their population. And basically the result is that a switch to a new world order is going to take time. And there's not a lot of great solutions right now, for instance, outside the US dollar for transacting trade. Now, we could go back to countries transacting. So a German country that buys from Thailand, they may always use a cross rate between the euro and Thai baht. And that may be what we move to, less of the pricing in dollars. That would probably be the first point. Now, you can say that what U.S. is doing by pushing Russia to the wall right now and sanctioning them, seizing their money that they have in U.S. dollars, basically what they're doing is they're forcing Russia to create their own trading block with China and India and others where they're going to trade directly. They have no choice. They cannot trade in U.S. dollars. So the U.S. politicians and the U.S. State Department are actually causing the demise of the U.S. hegemony, where the U.S. has the ability to basically rule the world. And that ruling is through the dollar. So I think it's going to take some time, but it's just going to be simple that Thai companies are going to transact with, let's say, Indian companies through rupee. They won't be talking about dollars. Now, ARK, Mr. Comboy says, what is the future direction of the yen and how will it affect Thailand in the short term? Actually, that's a good question. And I have to admit, I'm not up on the yen right now. So I'm going to leave that question. I don't think I got a great answer to it right now. So I just haven't followed the yen that much recently. Now, Plun Pun says, what conditions like inflation, GDP, rate hikes, oil price, Russia over, will the U.S. come back? Well, if Russia is over and a ceasefire is reached, then I think that could drive the U.S. market, number one. If inflation started to come down, that would give some indication that the Fed may not have to go up so high and their interest rate rises. And as a result, you could see the U.S. market coming down. And more importantly, if the Fed announced that they would be buying U.S. equities, then you would see the market come up. All right. Danu says, just wonder why we have to keep cash around 4%. Should we convert it into something in the future? Well, it's not really cash at 4% that we have. What we have is 4% or so in Thai money market bonds. And basically, I like the discipline of, I don't like the idea of taking cash and putting it outside of my investment amount, because you start to think of that cash as something different. What I like to do is include that cash in the portfolio. And of course, this is cash that you're not keeping as a safety reserve. This is the cash that you're investing, part of the overall amount you're investing. I like to keep a small amount of that as cash, which we'll call it bonds in this case. I like to keep it there because that just keeps us, first of all, knowing that even when things are, when we're in a situation where bonds aren't that attractive, we still keep a little bit in bonds. But also more importantly is we could sell those bonds and allocate that money to something else. And if we have to get that money from outside of our allocation, it just becomes a more complicated thing. All right, next question from Chawapon. As the higher volatility of commodities such as gold, how can you make higher return from this opportunity? Well, if you were a trader and you like trading in the market and you were good at it, then if we have a lot of volatility, you can be trading that volatility, buying low, selling high, buying low. But that takes a lot of skill. That's not my area of expertise. And as a result, I'm not going to try to trade around the position. But if you wanted to, you could trade around that position. Let's see. Next one. Yeah. So Heisenberg said the government bond. I think I answered this one basically saying there's not that much difference between Thai government bond at 10-year and 5-year compared to US. And so I don't think it's enough that it has a huge amount of meaning to it. Next one. Yeah. Kumpon says, is it time to invest in Europe? Well, I think you can see it's getting there. that's a great topic, Alex. I think that's something that we should consider talking about maybe next time, is when is the right time to invest in Europe? So I would say not right now, but we're getting close. Now, of course, if there was a ceasefire, then all of a sudden the pressures that Europe are under from the gas problem would be resolved to some extent. It would still take time to restart things. And I don't think that Russia is going to be welcomed back into the U.S., the global trading system by the U.S. So I don't think it's going to be resolved that easily. So I would say you probably have somewhere between 3 and 12 months before I would go rushing into Europe. Yeah, so Pongsakorn talks about the Kasikorn asset management low-cost funds, and we'll definitely look at those, and I'll ask Alex to write that down to keep track of that, and we'll go through that. All right. What's your view on the Japan market? Right now, I don't have a strong view on it, so I'm going to skip that one. Lee, appreciate it. Next question. Too late to invest in commodities fund. What do you think? Well, if the only thing you're doing is taking 100% of your money and putting it in commodities, thinking that that's going to outperform over the next 12 months or something, I would say, yeah, you're probably right that it's probably too late. You may get a 10 or 20% rise out of that, but there's some risk. For instance, if peace breaks out and then we see that the commodities come down. But from a long-term asset allocation perspective, I'm going to maintain overweight commodities, but see what happens in June when I revisit our allocations and talk about it. All right, next one. Will inflation go skyrocketing with 2 digits? Ben, I think that this is very possible that we'll see it. Remember, we're not seeing inflation's impact that heavily in Thailand because the government is subsidizing oil and gas. If they were to let off that subsidy, you would see very significant rises. And we can see that countries around the world, there are plenty of countries that do have double-digit rises, like Sri Lanka, like Pakistan, as an example, that have really gone through it. All right. Let's see. I know some of your figures are from Twitter. Any accounts that you recommend following? That's from Super Said. Alex, that's a good one. Actually, Alex, you and I should put together a Twitter list for our Thai AWS friends and followers and then share that. So we'll look at that. Let's look at the next one. Will China market recovery after the 2000 second quarter? I would say that, as I was saying earlier about China, I would consider a small allocation to China at this point. I wouldn't mind that. So if I invest in all-weather strategy, how would the portfolio be without you? Well, that's a good question. If I'm gone, then what would happen in that case? Let's just take the worst case situation is something happens to me. And if something happened to me, basically, you would all of a sudden have all the same allocation that you have right now in your strategy, because that's your strategy. You're just following along. You'd have all that allocation. Phenomena would be in touch with you and say, here's some ideas of what to do with that. You could leave those allocations and start adjusting them yourself, or you could say, I'm gonna sell all those allocation. I'm gonna follow another guru, or I'm gonna do it on my own. And so that's an important part of this, is that your money and your decisions related to the strategy are yours, not mine. I don't have possession or any impact on that. And therefore, if something happens to me, you're just going to have your portfolio and then you're going to have to decide what to do with it. And because it's not some sort of aggressive, for instance, stock portfolio, you don't have to panic because of that. Yeah, Lee said the downside protection looks impressive. And I would say, thank you. I appreciate that. I'm going to leave that about the Chinese market. Let me go through some other ones. Let's see. Okay, Patarapon says, what should we do with our investment in case of war? Well, that's part of the reason why I have gold. Because if war breaks out, we could see that. Now, already we have war, but I think you're talking about World War III, or it gets much worse. From that perspective, I would say gold is part of, this is the reason why we're holding 25% gold. You could see that markets initially get hit. From the research that I've seen about recoveries from war, the winning countries end up doing relatively well. It's not a total destruction. But if you're investing in the country that is a losing country, you're going to lose a lot of money. So gold is important. So Supawadi says, why is a Fed rate hike can impact to emerging markets? It's okay to keep investing in emerging markets for long term. Should we reallocate? I would say, first of all, the Fed funds rate hike will cause the US dollar yield to rise. And that will be relative to other markets. And the result of that is it can cause strength in the US dollar. And strength in the US dollar could be a problem, right? And also the other thing that we can say is that it can cause inflationary pressure and rising costs. Remember that in emerging markets, we don't have a lot of government subsidy of interest rates, as an example. The lending rates are not rock bottom like they are in the US. So sometimes we can see some impact related to inflation. Also, remember, emerging markets are energy importers. Thailand is like the second biggest energy importer relative to GDP. I think India is first. So if we have higher oil prices, as an example, we can see inflation spreading. So I would keep a small allocation to emerging markets, but I'd be careful. Also, the other thing is that when the US market crashes, the volatility of the Thai market is impacted. Now, I'm going to also make a mark to Alex here. I think this is a good question from Supawadi, and I think we can pull together some research to answer this question for the next month presentation. And that's the question of, why is a Fed rate hike impact emerging markets? How does that happen? How does inflation impact emerging markets, and how should we allocate? All right. So Obi says, what would be the right price for gold to take it into the portfolio? Well, I have it in the portfolio right now, right at 25%. So I liked where it's coming in right now. So I would say I don't have a great answer to that. Danu said you should come on more often. Yeah, I would like to come on more often. In fact, a weekly show would be fun. But the dollar recently broke out. Do you expect to see further appreciation? I think we're in a world of uncertainty, and in a world of uncertainty, the US dollar ends up being strong. So I would say that we do have the chance that the US dollar will continue to be strong. Now, I know the narrative for most people, including myself, is that the US dollar the US government has been printing so many dollars that at some point the US dollar is going to devalue. But I would say that that's a longer term issue, really. So next one is Panawit. I already have investment in AWAF. If I additionally invest in AWS, would it be beneficial to distribute the risk? Yeah, I would say AF, Alpha Focus, we're trying to take bigger bets, more concentrated bets in Alpha Focus. We have clients that you guys have said to us, I want more risk than all weather strategy. And that's what we're doing with Alpha Focus. So we're tilting the portfolio more than we would tilt AWS. So AWS is kind of boring. We're targeting about 6% per year. And Alpha Focus is going to be a little bit more exciting. We're targeting 8%, and we're trying to get that by being aggressive. Now, when you're aggressive, it also means that you're going to be in a situation where you're going to underperform too. So if I was you, it kind of depends on your risk level and your time horizon. But I would consider a mix between AF and AWS as fine. Also, the strategies, the way we construct the portfolio is very different. So you're not going to see a tremendous amount of overlap there. I think Alex has already looked at this, and this question from Wid, is it possible for AWS to switch from SCB S&P 500 to KUS 500X? Its fee is just 0.15 compared to 0.5. We'll look into that, and we appreciate all of the recommendations that you guys bring to us. We're always looking for ways, so we will take a look at that. Alex, if you can make a note of that one. Emmy Experience says, how strong do you think foreign fund flows buying Thai stocks? Well, what we definitely know is that foreign flows can have a huge impact on the Thai market. And I would say that you could argue that there's some investors that are allocating. They want to get away from the U.S. market a bit, and Thailand can be considered a place to kind of hide out. So I don't know about the foreign fund flows. I haven't updated those numbers. Alex, that's another thing that we could look at is fund flows. I don't think I have a lot of great data on that. We'll have to just check that. So Alex, if you could highlight ME Experience's question, and maybe next month we can do a little bit more. All right. Soranut says, is China A shares, H shares interest to invest in the long term, and which factors affect China equity? I would say yes, it's interesting in the long term, but my advice about China is have stop losses in place. In fact, one of our valuation masterclass bootcamp students has been investing in Chinese stocks, and he and I tomorrow are going to be talking about how could he come out with an idea about what Chinese stocks that a Thai person should own. So look for more of that coming soon. All right. Giapat says, is it time to buy growth stocks because 10-year bond yield almost increased to 3%? I would say right now we've been in growth stocks over the last 5 or 10 years. We've had a major rally in growth. So some people would argue that it's time to switch to value. And I would say that argument makes some sense. In AWS, we're not making that kind of allocation because that's just too detailed type of thing. We're trying to keep it as simple as possible. Plunpan says, you anticipate early June for AWS revision, implying commodities will crash. What to look out for, demand shock, recession. I'm not predicting that commodities will crash. And we have a regular set schedule for rebalancing AWS. And the next time that we're going to rebalance AWS is in June. Now, you may wonder why we have a fixed schedule. Shouldn't we be watching the portfolio and trading it as things happen? No, that's not the way the FVMR framework works. It's not the way we manage our AWS strategy. The way we manage it is that we set a rebalance consideration time every 3 months where we stop everything that we're doing and we spend all of our time trying to figure out using FVMR, updating all of our numbers and deciding what the allocation should be. And that's really what's coming up in June. It could be that commodities stay at the level that they're at. It could be that commodities come down, but I'm not making a prediction about a commodities crash. So let's see. Next one from Porn Tip. Do you think commodities can get higher? I think commodities could probably go a bit higher, but at some point I'd say we're getting close to the peak of commodities. That doesn't mean that they're going to come crashing down. I think that they may just stay high for a while. So if you took all of your money and you wanted to allocate it to commodities, I would say you're getting close to the peak. It could be another 3 months. It could be another 6 months. I don't know. But in June, I'm going to be re-looking at the portfolio together with Alex and Sonsa on our team. And when we do that, we're going to come out with our new strategy. We're going to bring it out to you, and we're going to come back online to talk about it. So it's now 8:20, and we've been going for a while. I really want to thank everybody for the questions. There's been great questions. I want to thank everybody online as well as in the YouTube and Facebook feed. I want to thank all of you guys for coming and listening to this. And most importantly, I want to thank you for following our AWS strategy. Our objective is to try to make a simple, clear strategy that allows investors to carefully grow their wealth. And that is the ultimate objective of AWS. You may feel panic sometimes about the stock market, about what's going on, but keep in mind that I never panic. I use my control of my emotion, my framework of FVMR to try to keep myself from making drastic moves when most people will get freaked out. So that's the benefit that you get from it. You got great advisors through Phenomena who can basically communicate with you, help you. If you've got a problem, reach out to your advisor and ask them. You can ask your advisor to ask me a question, or you can ask me a question also. I just want to thank you all for coming on to this stream, and I'm going to end it at this point. I hope everybody's back from Songkran. You're safe and you're healthy and you are doing great in your investments and great in your business. Remember, we create money through business and salary, and we grow money through the stock market. So we create and then grow our wealth. And the purpose of All Weather Strategy is to help you grow your wealth. So I'm going to sign off at this point, but I thank you all for your questions and for your attention. For everybody on the Line app, as well as Facebook and YouTube, have a great evening. I'm going to relax a little bit before I go to bed. Thank you all.